Okay, and so we should now be recording. Let me just check and make sure that is true. Let's see here. Yeah, we're recording. Good. Okay, so what we're going to be talking about now is the Intrinsic Value Wealth Report. The Intrinsic Value Wealth Creation Pyramid. And the way that we find that is it's going to be at the bottom of every week's commentary. So what you do is you log into the Intrinsic Value Wealth Report, you go to the commentary section, as we've done here, and then you scroll all the way down to the end of this current week's commentary. And this is a long one, so it's way down at the bottom, way down. And it is the second last section. It is called the Intrinsic Value Wealth Creation Pyramid. And so I'm going to open that up. And that is what the Intrinsic Value Wealth Creation Pyramid looks like. So let me give you a little overview of how this came about. I developed this a few years ago. What's the copyright right on it? It was 2015. So about 5 years ago now, I created this wealth creation pyramid, and it came about with some thinking I'd been doing about how to create wealth. I've been teaching some classes. So when I was, just growing up, if you will, and in business and starting out, creating wealth of my own and so forth, I'd always heard that there were three main ways to build wealth. And the three main ways that people often talk about build wealth are that you invest in the stock market, you invest in real estate, or you become an entrepreneur. And so I used that as a starting point. There's some background noise. I need to have someone mute themselves if they would, please. Okay, that helped. Okay, so again, there were kind of three accepted ways, or three ways that people often talk about, how you build wealth. Invest in the stock market, invest in real estate, be an entrepreneur. In other words, that's the way that most people made wealth over centuries, really. But I said, I want to see if I know there's other ways to build wealth, because I've been, studying this for a long time, teaching it, building my own wealth in various ways and so forth. So I knew that there were some other ways besides just those three. So I really sat down and I studied and thought about the process. And I came up with this wealth creation pyramid as part of that process. And it turns out that there's actually, what I came up with are 9 major ways of building wealth. By the way, there is an article I wrote for Forbes, because I'm a Forbes contributor. And that, as you can see here, this article, 9 of the best ways to build wealth. So if you go again to the commentary, you can find a link to that article that I wrote for Forbes. But I'm going to walk you through what that article basically talks about. So here's the 9 major categories of building wealth. And we're going to start down here at the bottom right part of the pyramid with these basically stock investments. So we have large and mid cap, and by the way, I like dividend stocks. That's just been shown over time to be a really good way to invest in the stock market. That's proved to be a case over probably the entire history of the stock market. So I always throw in dividends as being a good way. Whenever I pick stocks using our proprietary stock picking model, the Cassandra model, I always favor dividend stocks whenever I can find them. So we have so investing in the stock market, we have large to mid cap dividend value stocks, and then just large to mid cap value stocks in general, small cap value stocks, and then a category which is not understood by a lot of people. But again, when you can find them, it's a particularly good category to invest in convertible securities. And we'll talk about select convertible bonds, convertible preferred stock, and so forth. That'll be a subject of another podcast someday. Um, so we won't dwell on that tonight, but anyway, just kind of keep in mind that that's another, actually a convertible security, particularly a convertible bond, is a hybrid between a stock and a bond investment. Okay, so that's the one major category is stocks. Again, we'll do a separate podcast on each one of these categories as a separate podcast. All right, we're going up the pyramid a little bit. And by the way, I should explain on the pyramid that as you go up the pyramid, so if you follow my cursor here, as you go up, the returns get better, but the risk also increases. So you see here more aggressive, higher return potential. So we're going up from the lower risk to the higher risk categories. There's always a risk return relationship. The higher the return, the higher the risk you should be willing to assume. So as we go up the pyramid, that implies higher risk, but also you would expect to get a higher return from it. And as you come down, then of course the opposite is true. And the way the pyramid is constructed is really trying to show that most investors should have the majority of their assets by, as shown by the bigger part of the base down here on the pyramid. They should have the majority of their assets in lower risk securities investments and fewer in the higher risk categories. So so your return and your risk should average out, if you do this correctly, to something that's kind of more of a moderate return, moderate risk profile. So we covered the stocks, and as we go up again now, convertible securities are a little bit more risky than large and mid cap dividend value stocks, for example. Small cap stocks are a little bit more risky, and mitigate risk by diversification. I have several a couple of webinars and videos I've done on diversifying, and particularly with low correlated assets. So you can do those if you'd like, and again, we'll probably do more podcasts and so forth on those. All right. So as we go up, we have stocks in the blue, and then we have something called alternative investments. And our fund that I mentioned to you, the Northwest Quadrant Opportunity Fund, really concentrates in this category called alternative investments. And alternative investments are basically just anything that's not a stock and a bond. For a long, long time, when people would think about investing, especially like pension funds and large family offices and small family offices, whatever, they would think of a typical 60% stock, 40% bond portfolio as kind of a normal way to invest. And then about some time ago, I'm not sure how long, but more and more funds, Yale University, their endowment fund, I believe, was one of the first of the endowment funds to start doing this, but they started thinking about investing in other things besides just stocks and bonds, regular 60-40 investment portfolio, 60% stocks, 40% bonds. And they started investing in alternative investments. So alternative investments, again, they're investments which are a typical stock or a bond. And they might be real estate, they might be oil and gas, they might be private equity, they might be hedge funds, commodities, gold futures. Some people put convertible securities into that category. With our Northwest Quadrant Opportunity Fund, I'm going to probably put convertible securities in there as well as just being an alternative investment, which is what we concentrate on. So anyway, it turns out that alternative investments tend to have a very high return relative to other investments. And because of their low or negative correlation in some cases with other assets in a portfolio, they can actually reduce the risk of a 60-40 bond portfolio if you put some alternatives in there pretty substantially. In fact, we've even shown mathematically that you can even reduce the risk of a 60-40 bond portfolio down below the risk of the market by adding alternatives. So anyway, that's the alternative category. Now, special situations, again, are kind of they're a little bit of a difficult category to describe. They tend to be maybe companies that have, one definition I read is that it's a company that has a board action that In other words, the board of directors has to do something to create the special situation. They might be acquiring a company, or they might be being acquired, or restructuring. So there's many, many different categories of special situations. We put it up there pretty high on the pyramid because they can be very lucrative, but you really have to specialize, you really have to know what you're doing with special situations, and accordingly they have a much, much higher risk. Very, very top of the pyramid, at least on this right-hand side of the pyramid going up, are what I call visionary ideas. We talked a little bit earlier this evening about thinking outside the box, or actually even thinking, not even knowing that a box exists. So you're really, really thinking, out on the fringes, if you will. And I mentioned a couple of people, Steve Jobs and Jeff Bezos, when they had their ideas. Actually, Howard Schultz with Starbucks, any of these kinds of companies. And these are good examples, by the way, of visionary ideas for investments. These are the people that come up with these things are truly don't think they don't think inside the box. They're rule breakers. They're original thinkers. And I think I would kind of add that third category of thinkers. They're not thinking just outside the box. They're way beyond the box. They don't even know if the box exists. And that's oftentimes what you need with visionary ideas. So that's going up the right side of the pyramid. Now coming back down on this side here, the left side, we'll start at the top and go down. So, many, many studies, and kind of the conventional wisdom, if you will, is that most portfolios should have some international stock exposure. Now, because I'm talking to a group mostly of Americans that don't have any real experience investing internationally, you probably want to invest internationally using mutual funds or ETFs. So you want to have professional managers that do understand the other markets. I mean, the average person in the United States probably doesn't know a lot about China as an investment, or Taiwan or Germany, or whatever the case may be. But there's people that spend their entire careers investing in those markets. And again, they add a tremendous diversification benefit to a portfolio. And it's an area I think that every portfolio needs to have some exposure in. When we get to the asset allocation guidelines, you'll see that we always have some portion of the portfolio allocated to international stocks. And then there's passive income real estate. You can do that in a couple of ways. You can actually buy funds, real estate investment trusts and so forth, that invest in real estate, or you can do it yourself, and that's going to be a whole subject for another podcast, another night. Investing in income-producing real estate. And again, to those of you who are my students that are, as we're talking about building out our goals, our financial plans, you should probably be putting the idea of investing in real estate as one of your long-term goals. So passive income real estate means you're buying a home that you're going to rent out. And so you get the rental income. That's passive income. In other words, you bought the investment, you're renting it out, you get the income, you get some nice tax benefits, and you get appreciation in the asset. And you also get, if you borrowed money, which most of us do, to buy the real estate, you get a reduction in the loan, because your tenant, in essence, is paying part of what he pays goes to pay down the mortgage every month, and part goes in your pocket as profit. So passive income real estate is a real good wealth generator. This category down here, note here, I've said these are not really good wealth creators, but we can use them for income. And again, kind of the conventional 60-40 bond portfolio would incorporate some of these things: corporate bonds, government, federal agency, securities and bonds, and so forth. And many people put those in the portfolios. There's nothing wrong with that. And sometimes it's helpful just to have some cash in the portfolio too. But these are not your best wealth generators, but they are part of a wealth building strategy, and they're part of a portfolio. So that should be 7 of the areas we've covered so far now. The last 2 are entrepreneurship and then the multiple sources of income. These are the 2 items down here at the base of the pyramid. Well, entrepreneurship, again, that's going to be a subject for another night, another podcast, another YouTube video. And we can I've taught entire courses on entrepreneurship, but we'll talk some about that as part of this financial planning course as well. But that's one of the big, that's one of the big three I mentioned at the beginning: real estate, the stock market, and entrepreneurship have traditionally been the three biggest ways that people have built wealth in this country and worldwide over many hundreds of years. And then the final category is kind of I put it in there as a ninth category. It's one that just to kind of think about. That's the multiple sources of what I call multiple sources of income. And that encompasses several ideas. One source is that you would include all these other 8 categories we talked about. So that's maybe one source. If you put a job in there, or even a couple of jobs, okay, that's another source of income. But the idea is that, again, you want to diversify your income sources. And so the more you can do that without getting overextended, the better off you are. In this pandemic that we're in the middle of right now, people that had maybe 2 jobs, hopefully they didn't lose both. Maybe in some cases they did, but if you had a couple of jobs, maybe you only lost one and you still had something else to fall back on. Or, if some people have built up a lot of these other investments, then that might be what they're living on, is the income from those investments. Okay, well, I think that's the wealth creation pyramid. I'm going to turn off the recording, and so give me 1 second here.